The second key market challenge is where we really begin to establish our edge in the market. In fact, there are many good trading vehicles out there, but trading the right product only guarantees that you have a chance to win. The rest relies on your actual trading decisions. Our second key market challenge, then, is defining the market direction. First off, I'll say now that in order to give yourself the best chance to succeed in the market, you need a systematic method of decision making. You can't expect to be profitable in the long run if you just buy or sell ad hoc. The easiest way of systematizing your trading process is to trade with the market's direction. It may surprise you to learn that most market participants are not asking themselves this key question: which way is the market going right now? Instead, the most natural route for traders is to try to buy low and sell high. The question then becomes, high or low relative to what? Traders can never seem to agree on that, and that's how markets are made. In fact, we can see in liquid markets that there's always someone on the other side of the trade with a different opinion. To put it another way, traders are constantly trying to piece together the story of a stock or commodity to determine the fair price, to define what a stock or commodity should be priced at. If that doesn't sound impossibly difficult to you, consider what that really means. Can you determine supply and demand for a product, and are the numbers truly representative of what's going on? For a company, how are the earnings and do they justify the price? Is a PE ratio of 2 high for a stock, or is a ratio of 10 too low? Is there room for growth in the company? How are their competitors doing, and how strong is the market and the economy? How are those factors correlated to the actual stock price? What news can affect the price? And most importantly, what's already factored into the price? Then, can you make a trading decision with enough conviction to put large sums of cash at stake? It's no wonder that there's never a clear-cut conclusion to be drawn from this process. Not only that, but it should also be no surprise that this system is incredibly costly, subjective, and time-consuming. The only ones that can be successful with this approach are institutions that can afford the people and the resources to employ the best information, and that's their edge. They pour millions into hiring the top minds in the financial world. They spend day and night devoted to staying one step ahead, and they spare no expense at getting closer to the key information driving the markets. Yet even for these big trading institutions, it's still no layup. The market continues to confound these very experienced, very specialized traders, just like they do you and me. That's because the markets can often defy conventional wisdom, going directly against what seems logical. In these instances, market expectations have set a very costly trap, where an asset's value might drop like a rock in spite of very good news, or shoot to the moon after seemingly terrible news is revealed. One poignant example from 2012 comes from Morgan Stanley's stock, whose share price fell over 40% in a couple months' time, from $21 a share down to $12.36. Analysts continued to point to the company's books valued at over $30 a share, but somehow the stock kept dropping. How could it keep going down? People thought it was going to be a no-brainer to buy. Even now, weeks later, there isn't a clear-cut explanation as to why the price had to go down. In fact, the price may go up from here, but only after many people had lost a lot of money. This example also highlights another key flaw with trying to buy low and sell high in trading. As the price went down, up went the hopes of traders caught on the wrong side of the trade. Many compounded their mistake by adding to their position as it was only becoming a better and better value. They averaged down the cost of their net position, and it only added to their misery. The good news is that trading doesn't have to be that difficult or time-consuming. You don't have to value a stock or commodity because the market is already doing it for us. Everything there is to know about a product is already consolidated into the price, including insider information and market expectations. When trades are taken, it leaves a footprint on the chart, and if you know how to listen, the market will tell you how to trade. This brings us back to defining the market direction, or put another way, defining the market trend. The brilliant thing about this approach is that it's all about what's actually happening in the product that you're trading. If you can identify a trend early and stick with it as long as it continues, the rewards can be huge. That is exactly the principle Abels's products are based upon, and AbelTrend has been the market leader in this technology since 1994. For some traders, though, that doesn't seem to be enough. They think that just buying or selling with the market is too simple, and that you need to be able to predict where the market is going to go in order to make real money. Those are the ideas of counter-trend traders. We have to disagree with that approach. In fact, we suggest that like the traditional trading approach, counter-trend systems are flawed because they're still trying to determine what the market should do. But the market will never fall neatly into their predefined ideas. Traders that try to predict the top and bottoms of the market are always going to be on the wrong side of a big move, where the real money is to be made. We encourage traders not to be afraid to miss some of the price action before the market shows us that the timing is right. Counter-trend traders that are unwilling to do so have constantly had to change and revise their trading ideas to keep up with the market, and their methods are becoming more and more complicated. Traders first look to analyzing charts in order to simplify the process and get a clear, objective trading decision. Trading systems today have become so complicated that it's impossible to make critical, time-sensitive trading decisions through all the analysis. AbleTrend gives clear, objective indications at the beginning of a trend. The signals are calculated dynamically in real time and follow robust principles that have continued to excel in some of the toughest markets traders have ever seen. AbleTrend's proprietary calculations have remained consistent since 1994, and they have never needed to be curve-fitted. That's the AbleTrend advantage. In this video, we talked about why it's so critical to define the market challenge correctly. If you aren't seeking to define the trend, you're making trading too difficult for yourself. It's nearly impossible to consistently price an asset better than the market can. Trading decisions also need to be clear and objective, especially when large sums of cash are on the line. These characteristics are all built into AbleTrend's early trend recognition technology. The final market challenge covered in the next video is the most important one of all. Join us in the next video to learn the finer points of risk management.